Good morning, I'm Maurice Crespi, Managing Partner of Schindler's Attorneys. Schindler's Attorneys is a co-founder of COBRA. COBRA was founded just after the lockdown by IQbusiness, Engaged Business Turnaround, and Schindler's Attorneys. And the idea behind COBRA is that we assist businesses in any which way we can. We set up private meetings with you and your team, if need be, to answer questions. We have a knowledge base on our website, www.cobra.org.za. It's the most comprehensive in the country. We can assist with the business rescue process, engage business turnaround, do just that. We place you in business rescue if required, and that's important, only if required. COBRA has successfully kept most of the businesses out of rescue. Rescue is not required at the moment, so COBRA is not about rescue, it's about keeping the businesses out of rescue. And part and parcel of the pro bono offering are these daily webinars. And today we have Sifiso, who will be wrapping up on the week's events. And obviously the most important is the interest rate cut. So I'm going to hand over to Sifiso. Sifiso, thanks so much for joining us today. Yeah, let us know your thoughts.
Morning, everyone, and thank you, Maurice, for the introduction. Yeah, so it's been quite an interesting and a colorful time on the economic front. There have been a lot of developments since we last chatted. You know, we've had GDP numbers come out, we've had unemployment numbers come out, we've had inflation numbers come out. And subsequently, and as of yesterday, we've had the interest rate decision come out. And I thought, let me work it back and hopefully give you some interesting context then around you know, some of the value points around there. Historically, the Reserve Bank Governor Lesetja Kganyago is often taken. We've started calculating, it's about 12 minutes to give the monetary policy statement. And if you follow the language that they've historically used is, one, they always talk around a price path, and I'll get into the details of that. They often talk around an economic growth context. They often talk about their mandate as a reserve bank and their role in the context of the growth equation. And they often talk about geopolitics or the global landscape and how that contextualizes and informs the decisions that they make. Starting with the price path. And so the two things that really go into informing their expectations from a price path point of view. And if I start and say, the mandate of the Reserve Bank is price stability in the context of sustainable economic growth. And therefore, the primary focus is around ensuring that the economy doesn't overheat. And one of the questions that I've always asked then is that, you know, how are you anchoring your choices on overheating in a very cold economy? We can get into the philosophies around that, but in essence, their position has always been around ensuring that there's price stability in the context of the economy. Two things that go into that is what happens with the currency as well as what happens with inflation. We saw May inflation numbers coming out. I think the last time inflation had been that low had been, I think, had been 2004, if I'm not incorrect, and inflation came out at 2.1. One of the biggest drivers for that was oil prices. If you remember, end of March going into April, at some point we had seen oil going below zero. In essence, you know, traders were being paid to take oil because of oversupply, and that was primarily driven on the back of you know, oil futures in the US, as well as increased supply coming from Saudi Arabia, where in the month of March, there had been a record shipment of about 12 billion barrels coming from Saudi into the American market. And we saw then Brent crude oil going below $20 per barrel. At some point, I think it was about 18. And it has subsequently recovered and rebounded. And the Reserve Bank now is pegging, or at least modeling, an average oil price for the year of about $40 per barrel. Currently, it's sitting at about 33, I think. And again, that's probably on the high end, given the fact that we have seen the oil-producing countries, OPEC, coming out and saying that you know, the rebound in oil prices, which was at some point close to 100%, in essence, is certainly I think sufficient for them to now get back into some profitable space, and they'll probably bring some supply back into the market. And so we'll probably expect oil prices to level out at about 32, 30 for the year. And therefore, the oil price being the largest contributor to the kind of the deflation that we saw and inflation at those price levels means that in the month of June, you're going to see higher inflation numbers, and therefore there's an expectation of inflation to rebound. However, the other contributor to low inflation numbers is just the lack of demand in the economy. And of course, that is informed by a lot of the data points that we are seeing in terms of, one, the level of business activity. And as I said, is that while theoretically the economy is said to be operating at about 80%, we are seeing that banking transactions are seeing activity happening between 48 and about 53%. And therefore, you know, there's still a lot of capacity that just hasn't come on board. And that means also then lower hours worked and lower household incomes, and therefore lower expenditure in the context of the economy. And therefore, we're expecting inflation to probably average at about 3% for the year. And that's still very far from the 4.5 inflation target that they're modeling. And so that's one of the things. The other things that drives inflation, of course, is our currency. At the May meeting, the Rand had depreciated, I think, by close to 22% to the US dollar. It's since gained some favor, and now year to date it's only depreciated about by 15%. And you'll see the Turkish real, the peso, the ruble, all of those have actually performed worse than the South African currency as emerging market counterparts, in essence. And so I think the South African Rand remains quite interesting to the global investors. And just to give you a little bit more context, South African Rand is the 18th most traded currency in the world, and about 84% of those trades are being done by foreign investors. So that's, of course, then seen them buy some South African bonds in the period, and that's why we've seen some Rand strengthening. And again, how does this contextualize to the price path? That it means, of course, if you've had your currency, I think, pay up some losses, that certainly means that there'll be less inflationary impact, which would be a function of a weak currency, given the fact that we buy things like oil in dollar currency, as well as a lot of the other imports that we need for domestic consumption. And therefore, the first thing then is speaking around the price path, and we can see that if we're expecting average inflation to be about 3%, it's very far from the 4.5% price level, and therefore the inflation target, and therefore that's the first thing that gives them room to consider an interest rate cut. The second thing that gives them room to consider an interest rate cut is around what is happening globally. Are the other economies looking to remain accommodative and therefore, in essence, talking about remaining in a low interest rate environment? Or are they expecting some inflation to come up and therefore they start the interest rate hiking cycle? We are seeing, wars come back and it looks like data wars now, and privacy wars and information wars. And so we've got the UK now at war with China. We've got the US now at war with China. We heard yesterday one of the Chinese consulates, I think it was in Texas, got closed. And that's already just pointing to heightened tensions from a geopolitical context. And that usually is a dampener for growth expectations in a global context. That usually then means that also the inflation is probably going to remain muted in those economies, and therefore their monetary policy is going to remain accommodative. That backed by the fact that you're seeing, for example, countries like the US, Brazil, India, now being deemed as, in essence, unable to deal with the coronavirus pandemic as per World Health Organization. It means then that also, drives a lower expectation from a growth point of view in those economies, and which again is supportive for an accommodative interest rate environment in those countries. We've actually seen bonds being sold at negative yields, both in Europe as well as in the States. And therefore that's certainly starting to point towards, I think, a continuation of this accommodative environment. What that usually means is that the interest rate differential between those economies and South Africa is what we call the carry. And that's what makes South Africa relatively more interesting for investors to come see and get some yield pickup from an investment point of view. And then the last thing, which of course ties into the broader conversations around economic growth, is around the economic growth context in South Africa. We are in a recession, third quarter now of negative growth, and we're expecting that to continue into this quarter, and the numbers to be materially worse than the ones we saw in terms of first quarter versus second quarter, because a lot of the lockdown impact would have been felt in the second quarter. A lot of the numbers that we saw, and I'll get to that, in first quarter GDP numbers were largely driven by, for example, Eskom and load shedding. But I'll explain some of the implications there. And so when you then look at the South African context from a growth point of view, we've got a third quarter. We've had 3 quarters of negative growth. We're expecting to go into a fourth quarter of negative growth, and therefore, again, that's one of the considerations. However, if you listen to the last MPC statement, they did mention the fact that they are probably closer to the trough in terms of their rate cutting cycle. And if you follow them historically, they've always been a lot more conservative in their use of monetary policy in spurring demand in the economy. And that's a really important question around what is the role of monetary policy in driving growth. And that then leads to the last thing that the Reserve Bank governor continued to emphasize, was that we can't use monetary policy to solve for fiscal failings. There is a space for monetary policy to enable directional growth but monetary policy in and of itself can't be a driver of economic growth. Continue to emphasize that their mandate is price stability in the context of sustainable economic growth. And then that, of course, then informed their decision to cut rates only by 25 basis points. Two things then that are quite interesting when we get into the detail. The first is that who does a rate decrease benefit in the context of Africa? Because mostly it is more of a relief mechanism than it is a demand driving mechanism. It means then that it relieves businesses that have debt facilities, and it relieves mostly higher income people in the economy who've got long-term debt, mostly long-term debt in the form of houses or cars. And the impact for example, some of the people on the lower end in terms of their cost of servicing their unsecured lending, etc., certainly does bring some relief there, but the net call it broad benefit is more on the higher income earners in the economy. That then means that whatever you continue doing with the interest rate, it still won't solve for the developmental challenges that we've got in the economy. And I think this is what the Reserve Bank governor was talking around, is that there's a fiscal need that can't be closed by monetary policy. A lot of the people you'll hear, and Paul Krugman speaks in his book called Arguing with Zombies, he speaks of zombie ideas. And it's these ideas that were disproved, and for some odd reason, they just keep coming back and they keep resurfacing as dressed up a little bit differently, but asking the very same question that got answered. And a lot of that was asking, for example, in terms of what we call modern monetary policy theory, MMT, and saying, can you print yourself into growth? The quick answer is no. And there are only a few economies in the world who've kind of been able to do that. And I say kind of because they actually, they've got an economic structure that has very synthetic views of or synthetic elements to what we see as growth. The US is probably the most successful economy in the world in its ability to print itself to growth. But it lends itself largely to the structure that a lot of things that go into the questions around what would enable that. And there's things like, for example, sovereignty of your currency. And many people will say in South Africa that we do have a sovereign currency. And well, I'd say, yeah, theoretically we've got a sovereign currency, but to be honest with you, if you were to look at what we call the VIX index, which is the volatility index of the currency in South Africa, 95% of the changes in the VIX are informed by everything happening outside of South Africa. And therefore, the extent to which our currency movement is informed by local developments is actually quite minimal. The extent to which the level of our local currency is informed by the strength of our current economy, at least, is minimal. I mean, I'll explain is that 60% of the portfolio flows that come into the economy leave within a period of 18 months. And you can imagine the kind of impact, for example, that can have on a currency volatility. And so very quickly, you could literally print yourself into a hole. Because as soon as you print and then the currency differential swings in one way, you could literally get into a hole that you can't get out of, and next thing you're at the door of IMF and knocking, truly now in need of a fiscal support package that would come, of course, with the reform requirements that IMF loans usually come with. And again, in the South African context, that just doesn't hold. And so this idea, this zombie idea, and we keep trying to re-kill this idea that we can print ourselves into growth, is certainly a dead idea, and we have to re-kill this zombie over and over again because it's also tied to political ambitions and political posturing. We then need to say, well, if I were to tell you and say that the two biggest challenges facing the South African economy is a loss of productive capacity and poor and low investments into human capital development. And then I would ask you and say, how do you think that monetary policy can solve any of those two problems? And I'd be happy to have any question or any answer that suggests that monetary policy can drive any of those two. And so we understand in that the answer towards a more progressive view of economic growth in South Africa is not around monetary policy, but maybe around financial institutions and financial intermediaries, and say, are financial intermediaries playing the right role in driving development in the economy? Our banks have historically been quite conservative in the way in which they disperse loans. and business funding. They've also been seen to have challenges in their modeling, in their credit risk modeling, because, for example, women have got lower access to credit facilities than men, yet their credit paying behavior is much better than men. And so these are some of the things that are questions that would probably be a lot more valuable in us asking around the entire financial system and the role it plays in driving developmental outcomes, in driving more broad-based access to finance for small businesses, for medium-sized businesses, and concessionary loans and all of those things, and developmental finance. That's the interesting question. And yes, there's some developments happening around impact investing and ESG, and development finance as an area is becoming more colorful. But I don't think that that's developing nearly as fast as it should, primarily given the fact that we do have a mature financial services industry, and therefore from an infrastructure point of view, we certainly can model much better around how to leverage the financial system to drive sustainable growth, and the financial system as a particular enabler for developmental outcomes of the economy. And so if we then say that monetary policy can't solve for the lack of human capital investment in the economy, monetary policy can't solve for the lack of investment in R&D, monetary policy can't solve for the loss of productive capacity, and then that idea must stay dead. This idea, this zombie that has been killed, now we must re-kill it again. And that then, for me, sums up this argument around, you know, the role of the Reserve Bank in driving growth. Is an enabler, I think, for growth. It's around ensuring that the inflation, for example, doesn't create a problem for businesses, doesn't create a problem for access to asset building and wealth building. I mean, one of the things that you see in some of the countries is first-time home buyers have very concessionary rates, right, quite low. And therefore, that is a directional push towards people becoming asset owners. These are the things that I'm talking around how the financial system itself can start to think of colorful ways in which they can truly drive more sustainable, wealth creation, more sustainable development in the context of the economy. And so that's the interest rate question. That's I think the context behind some of the decisions that the MPC made. And I don't expect that we have that much more room left, given the conservativeness from a Reserve Bank point of view, for further rate cuts. At best, it would be another 25 basis points. And I think at that level, we would probably be at the trough. And so for businesses now who are on the call and who've got facilities, it might not be a bad idea to start having conversations with your bank around maybe fixing portions of your facility at current levels. I think these levels are truly accommodative for that. And one of the criticisms that came actually to the Reserve Bank around the interest rate cut itself is that if inflation is currently at the levels that it's at, and now interest rates have been cut by 300 basis points, it means that the effective, I guess, or the real cut or the real interest rate benefit is not that much. It's probably 50 basis points because of inflation levels. And the other argument around that is that inflation can tick up much quicker than the pace at which the Reserve Bank can increase its interest rates. And so maybe right now it holds true that the real interest rate benefit that is accruing to consumers and debt holders is about 50 basis points. But I think there's certainly an interesting counter argument around the pace at which inflation can turn around, yet still at more accommodative interest rates. If you look at then what happened with the economic growth numbers that came out for Q1, with mining and manufacturing being the largest contributors to the negative growth that we saw. And of course, when you think about who are the high energy users in the economy, it's exactly those two sectors. And so with the load shedding that we had late December, early January, I think it was November, December, and some in January, the impact then would have been quite material in terms of production in the context of those sectors, and those numbers in essence were barely surprising. It was also at the time when there was still uncertainty around Brexit in terms of the signing of that. There was still uncertainty around China-US trade deal. And so there was a lot of kind of trepidation in the global market also in terms of consumption spending point of view, and therefore demand for some of the commodities would have also been depressed. Over and above that, there's usually what we call the January effect, and you usually see depression in a lot of the stocks coming out of January, and that tends to also have an impact on sentiment, particularly for some of the export-led commodity goods, and therefore commodity prices tend to come under quite a bit of pressure around that time as well. And so these are all the things that certainly contributed to the negative growth numbers that we saw in the first quarter. And when I said the two most visible pillars or drivers of poor economic performance from a South African point of view, the structural constraints that we see are informed by loss of productive capacity and poor human capital investment. I mean the fact that when you look at manufacturing and its loss in terms of its contribution to GDP, and if you look at the import intensity that has also followed, and import intensity truly speaks to just how much we need to import to inform domestic demand in South Africa. From China alone, between I think 2001 and 2010, we saw imports move from about 0.5% of GDP to about 5% of GDP, and that's just China alone. And there are a lot of other economies from which we import things like, some of the grains like wheat, rice, Vietnam, etc. So the number of goods that we continue to import just to sustain domestic demand, and import intensity has been increasing. And therefore, what's happened in the South African economy is that there's been the missing middle is getting more missing by the day. And so even if you look at wage growth in the context of the economy, it looks a little bit like a V or U shape. And so the low income earners, because they're coming off a low base, any increases in their earnings percentage wise looks interesting, looks bigger, but it's just a low base. And then it's been the high income earners who actually had real income growth. And there's nothing in the center, and there's nothing in the middle. And that is your biggest sign of a constrained and a crippling economy, because that's where that's where the real dividend of the economy is. It's in that industrial base that should be in the middle there. And if you're seeing no development happening in that middle, that's when you know that the economy is really, really under a lot of stress and under a lot of pressure, I think, from a capacity point of view. And these are the things that we ought to be thinking about when we're now talking economic growth and saying, what does it mean to build productive capacity? I even made the example and said, government has often been criticized, and rightly so, for the negative association with tenders, where a lot of it tends to be associated with people with no track record getting some tender to do something, and then they overprice it like we've been seeing in the news, and in essence then they milk the state out of resources that should be driven towards service delivery, etc. Even that model can be used well. I'll make the example. Say, if you had someone who who's got a tender to sell paper to a department. If you use your procurement process, and this is a fully budget neutral way to build capacity in the economy. If you use that, if you use your procurement process and you say, if you're selling us paper today, if in 5 years' time or in 3 years' time, you haven't built capacity towards having a factory that makes paper, and then you can no longer be a service provider for us. If after the 5 years' time, you haven't gotten into forestry, and then you can no longer be a service provider for us. And then this is the framework that will enable you to grow into the sectors that will enable you to participate in broader value chain space. And therefore, you use what would otherwise be an inexperienced, for example, a paper retailer, into understanding and into getting scope and participation into a manufacturing context around the very good that they were providing, into then understanding their opportunity for participating from a forestry point of view. You start to create economies of scale, and also you can drive down the real price of those goods over time. But what you've done there is starting to build professional capacity into the economy. And so from a fiscal point of view, you haven't outlaid any money, but you've enabled businesses to move from just small procurers of papers from one agent to another to becoming real productive agents in the economy. And these are some of the things that we ought to be thinking around, given the fiscal constraints that we've got, is that not every solution that we've got requires a fiscal disbursement for it to actually be a value accretive in the context of sustainable economic growth. Then the last challenge that I want to get into, which is the unemployment challenge. Sure, that one is probably the one thing that keeps me up at night the most, and it speaks to not only the numbers, and so the numbers are just reflect the story. And so we must often tell the story and use the numbers to substantiate the story, and not the other way around, where we start with the numbers and try to use the numbers to tell the story. The economy, in essence, all it means, in the simplest and crudest terms, it means the economy has become disillusioned from the people that it's supposed to serve. Simply, that's what it means. And if the economy, in the way in which it's currently designed, does not serve the youth, and then who is it meant to serve? Because it's clearly not future-proofing itself and it's not positioning itself for sustainable growth. So there's clearly something happening on the one side in terms of how young people are coming up, and what their socioeconomic context and their participation context, and it's almost a hoax where you are preparing people for an economy that no longer exists, and that for me is the most burning question: is that, are we as aware as we should be about the economy that we ought to be preparing young people for? And I think that question is the reason we find ourselves here, where we've got an extended definition unemployment rate for young people in excess of 70%. That's absolutely insane. We've got an extended definition unemployment rate for Black women of 48%. That's unacceptable. That means on average 1 in 2 Black women in this country are unable to become economically active. Yet when you look at the average output per worker, that's grown over time. The capital per worker, that's grown over time. Productivity per worker, that's grown over time. Yet you still also have, for example, what we call underemployment, and that's close to 700,000 people in the economy. And those are people who are employed, but are underutilized in the roles that they are. It's either you have a law degree and you're a security guard, in essence. That's what we call underemployment. And so we've got, as much as companies have clearly been sweating their assets a lot more over the years, yet wages are not picking up and growing at the rate, at a commensurate rate. you're starting to see, or at least we're seeing that there's clearly a big shift in terms of what's coming in from the demand side and what businesses see, or it's coming in from a supply side and what businesses see as a demand side. And there's clearly a need to close that gap. And the more we lack deliberance about trying to do that, the more we're going to see these numbers worsening, simply. And so all of the things then that ultimately come into conversations around our GDP, for example, 60% of it being a function of household expenditure, where now households are coming under pressure. The other 20% being a function of government investment, gross fixed capital formation. Government doesn't have money. And so where is growth going to come from? And it leads me to the last bit of the conversation that I want us to have is around how we remain okay with this idea that gains must be privatized and losses must be socialized. And in essence, when corporates make money, no, it's corporates. They're the risk takers, and they clearly created their own conducive environment to do that, and therefore they must realize all of those gains, and then they must be attributable to the shareholders. And then when losses come and say, no, but government, how do you let this bank fail? No, this bank can't fail. There are so many people's pension monies there, or there's so many jobs that this company has created, and therefore we can't let them fail. They're too big to fail, and so government must come in and bail them out. And then when you have conversations around, for example, social levies and levies that speak to the environment, the investment that needs to go into the environment for businesses to operate, then they don't want to participate in that conversation too. And I think there's an honesty that we're now going to need from private sector around what does it mean to operate in an economy where we're all social agents in that economy. And the endogenous growth theory coming from Paul Romer says that the base effect that is created from what was previously accumulated is something that we can't ignore. And so when I was born, there was tar in some of the roads. I didn't build that road. I didn't contribute any tax to that road, but I'm a beneficiary of that road. And so when I become an active economic agent, what do I pay back? And don't tell me taxes. So there's a disillusion around two equations that I often talk about, is that there's a revenue collection equation, which is a tax, and there's the growth equation, which speaks to savings, investment, and any borrowings. Those equations cannot be simultaneous equations. Tax is not expenditure. And the view through which we look at these things should energize, I think, a very different lens around how we all participate in this economy as social agents to ensure that growth is attributable and is realized by everyone who participates in it. And this is why I'm saying that there's an honesty that we need to have around this conversation, that we continue to be okay around privatizing gains and being okay around socializing losses. And I don't think that is a sustainable way of looking around at how we all cooperate to drive this economy forward. And so that's certainly, I think, going to round up this session around some of the things that are grounding the economic developments that we're finding in the economy, the things that are grounding the decisions that are being made at an MPC, a Monetary Policy Committee point of view. And I think some of the thinking that then we can expect to come out at the future meetings that are going to come out next month and the following month, leading up to the October midterm budget statement. Thank you very much.
Thanks, Sifiso. I'm not sure what's happened to Gary. Perhaps we can cover some of the questions that have come up in the Q&A. The first one that came up was from an anonymous attendee in the Q&A saying, what are the economic implications of having a low inflation rate, and who benefits from it, and who is negatively impacted?
So there are the benefits is that one of the largest contributors, for example, to the inflation basket is the food inflation. And when we've got low inflation and particularly low food inflation, that has particular benefits for the lowest income earners, especially in the economy. And yes, there are some food items that are zero rated from a VAT point of view, but in general, lower inflation just means lower general prices in the economy, and so everyone benefits. But I think because the lower income earners spend a larger proportion of their income towards food, they benefit more incrementally from lower inflation. That's the starting point. The other point, as I said, is that people who've got debt facilities, particularly that are not fixed, if you had fixed your debt facility at the higher interest rates, unfortunately, you wouldn't have realized any gains from the interest rate reduction. And so when inflation tends to trend down, often your cost of borrowing tends to go down. And that's the second impact. The impact on financial institution is indeterminate. There's what we call the endowment effect. And so on the one side, there's benefit for banks when interest rates go down because the credit loss provisioning often goes down because you expect less people to default. And that's beneficial for banks. But it also means that they're losing money in terms of their borrowing, right? They borrow at a lower interest rate from the Reserve Bank, and they lend it out at a higher interest rate, and so their ability to make more money from lending activities is diminished, and also then there's the differential between the rate of change of your lending and the interest rate environment. And so again, I said that there's some people who've got fixed lending solutions, and so banks are the net beneficiaries there because they continue borrowing at significantly lower rates, and your lending rates were fixed, and so the delta there is higher, and so financial institutions can be net beneficiaries there. Other beneficiaries are, for example, insurers, because they've got quite a close tie to them, in essence, the shift in the market in terms of particularly households. And so when people have more disposable income, they're more likely to buy insurance product. And when they've got less disposable income, they're less likely to buy insurance products. This also applies to, of course, I mentioned the food retailers. And so there is benefit, I think, in the broader economy from a low interest rate environment on balance. And the benefit is just uneven depending on which economic participant that you're looking at.
Great. I just want to link back to a question here from Safaraz, just because it's talking about that reducing the cost of debt that you were speaking about earlier and the benefits of it. He says, as a player in the financial advisory space, what are your thoughts and suggestions on how we can advise businesses and individuals to better manage their current economic situation? You mentioned that the greatest benefit of things like the rate cuts is to reduce the cost of debt, which the majority of citizens have had to get into during this pandemic.
Yeah. Sure. I mean, I think it's a difficult question for me to engage. I think there are different answers for different problems in that context, and besides the general conversation that, you know, try and optimize your capital structure, try and not use debt to fund your operations, but at best, if you're using debt, use it to invest into growth. those are, I think, are general and high-level recommendations around managing your operation and capital structure as a business. But I think from business to business, the nature of those businesses change, right? Some of the businesses, for example, are a lot more capital-intensive than others, and others are a lot more labor-intensive than others. And so, for a services business, investment looks very different than a mining business. And so I think it's quite hard to be quite general around it. And goes back to the question, I think, around the role of financial institutions in driving and investing for growth. China has got a rolling 5-year cycle of target sectors. And when a sector is a target sector for growth over that 5-year period, they've got a fund that is associated with investment into that sector. They model default ratios in excess of 90%. So in essence, they're saying, we're expecting most people who are going to borrow here to lose the money. But we're going to get R&D out of it. We're going to get the re-entry process. And you'll hear from many entrepreneurs that a lot of the businesses that have become successful over many years actually had 2 or 3 re-entry opportunities in terms of their financial viability. They were financially viable, became unviable, and went back. And maybe the second or third iteration, they actually then were able to build a base through which they could grow in a long-term sustainable basis. And we've got to get into that thinking, creating a culture and a comfortability for failure, because learning comes from failure. And one of the other economies that I usually use as an example is Israel. 13 years ago, Israel was drought-stricken. 13 years ago, and they're an abundant country today. And if you look at how much they spent on R&D, which is what we call the GERD, gross expenditure in research and development, we target a 1.5 expenditure GERD as a percentage of GDP. We're currently spending 0.8% as a country. And Israel, leading up to becoming water abundant, was spending in excess of 5% of their GDP on research and investment and development. And we can't take for granted the benefit of knowledge as an asset in the economy. There's no reason why, for example, we're still not the largest producer of research in genome production for all of the agricultural products that we're exporting. We're the #1 citrus exporter, but we're still buying seeds from somewhere else. It makes no sense. And so when you do, have a contextual view also towards, the benefits of R&D and knowledge accumulation, and that also comes through the failing process. And this is why then bringing it back to the question is that from a funding point of view, we've got to have blended solutions, blended financial solutions that lower the risk, and therefore also increases the appetite to fund failure. That's the way in which we're going to enable businesses to move from kind of subsistence small businesses into middle-sized businesses, into large businesses. The challenge we've got in the economy is that we've got only a few large businesses. We've got a concentration challenge, and therefore that puts a lot of risk on the sustainability of our tax base. And therefore, these are some of the things that we have to be asking around the role of financial institutions to create a more sustainable tax base for the country. And I think that ties in, and then with that question around ensuring that what do you do in an environment like this, and what do you do from a borrowings point of view, and how do you manage your thinking around optimizing your capital structure as a business.
Sifiso, I think I'm going to jump in there. We've got only about 9 minutes to go, and we've got about, the questions are streaming in. So I'm going to start in the chat box with Mashekwa More. There's a question for you. Do you think the lending behavior of banks going forward will improve to be more inclusive, or will they become more prudent?
do I think the lending behavior has become more inclusive or more prudent? Yeah, I think I think the one is not the antithesis of the other. You can have an inclusive lending approach that is prudent, so they're not necessarily mutually exclusive. I do think that a lot of the banks have become a lot more prudent over the years. If you just look at I think there's only one bank actually who's almost loosened their lending criteria over the last decade. A lot of them have tightened their lending criteria over the last decade. There's clearly evidence in the marketplace that there's bias in their modeling, in their credit modeling as well, and therefore there's less credit going towards women, and there's less credit going towards Black people. And when credit is going towards those two buckets of participants in the economy, usually comes with a higher interest rate. And so there's something that's still quite problematic there. Lee Nike, who's the CEO of TransUnion, I think we had a conversation 2 days ago, and he said something quite interesting around what they're working on, which is using data to help businesses close their output gaps and better assess sources of demand and better manage their costs. And so I think businesses also must look at new innovative approaches that help them optimize, I think, how they go to market and how they play in the marketplace. And they must utilize some of these institutions that have deep and large data sets to be able to, I think, position themselves for growth. And that way, hopefully, then the emphasis is not so much on lending, but rather on investment and growth activities.
Okay, a question from Salfaraz Khan. As a player in the financial advisory space, what are your thoughts and suggestions on how we can advise businesses and individuals to better manage the current economic situation? You mentioned that the greatest benefit of things like the rate cut is to reduce the cost of debt, which the majority of citizens have had to get to during this pandemic.
We already addressed that one, Gary.
Sorry, Gary.
Okay, no problem. I'll move on to then, that one's been addressed. We got a question from Adam, who's the CEO of IQbusiness. He says, last night's announcement by the president that public schools will take a break for another month has a knock-on impact on the parents, especially those working. Do you have a view on the economic implications of this and other decisions like alcohol and cigarette sales?
Sure. I had a lot of reservations about that. On the one lens, you kind of sympathetic that you're trying to make sense of why they'd make that kind of a decision, and they're speaking around the peak of the virus and schools not being festering grounds. But again, but you're still not consistent in how you're applying that, because, for example, your taxis are fully loaded. And also private schools are operating, and private schools also have this blended approach now where it's some of it is online learning and some of it is physical learning, if I can call it that. And these are the things that will create inequality and make it worse than it already is, because one might think 1 month of learning is not material, but it actually really is. And so it's certainly, I think, going to exacerbate the difference between educational outcomes of people who are in more privileged spaces and those who aren't. And I think there's certainly, to the second part of the question around the ban of cigarette and alcohol sales, I think they're looking at the wrong part of the problem. I mean, South Africa is the only country in the world where a contraband cigarette sold more than the legally defined brands in the economy. The only country in the world where you've seen that, and therefore, the illicit trade in the economies is clearly crippling for that industry. And so, for me, is that you don't create a festering ground for that to even get better at being at operating illicitly. So the focus is certainly not on the right thing. And yes, there is empirical evidence that shows that when alcohol has been banned, there's lower pressure on beds and all of that stuff in hospitals. But maybe that can be achieved, for example, by a harder crackdown on people being on the road. And so, if people then aren't allowed to be mobile, and so you use the curfew with a lot more emphasis, and then people are going to be drinking at home. And so it's all of those things that, for me, I think show that they're now just under, they seem frazzled, they're under a lot of pressure, and they're really making decisions that they're not coming back and bringing us on board around how did we get there, what numbers did we model, and how do we think this is going to have a short-term impact, long-term impact. These are all the things that should be going into the assessment before they come out with the decision. And I don't think that they are well-considered decisions, and I think there are better alternatives, I think, to the lockdown, to the alcohol and the cigarette ban.
Sure. I think, Sifiso, let's take two more before we close up. Kelelelo Kadimeng has got a question. With such a highly regulated financial services industry, how does an institution relax their lending criteria without being penalized by the supervisor?
Yeah, I think, those are probably unrelated questions. So the lending in the supervisory environment in South Africa around reckless lending is very different to the environment around financial institutions being an enabler through higher financial inclusion and higher provision and better understanding of the client. And this is where a lot of the questions should be asking, is that, are the systems that banks using right now outdated in the way in which they understand their client? Gary, if you don't have a credit record right now, you might never qualify for a home loan. Yet you could have large disposable income and a lot of capacity to pay that. And that's the question, right? And this is, so for me, that question is certainly different around the question of reckless lending. We must certainly move away from reckless lending. But I think the metrics that we are using to assess credit viability are certainly not progressive. They're not forward-looking. They're using historical data that may not necessarily be informative of future behavior. And so we need then, I think, smarter and more innovative approaches to using data, to understanding relationships between data points that will inform better understanding of the clients that we're servicing.
Yeah, let's finally end with Sarfaz Khan's other question. Do you foresee that we will experience a glut of bad debts at the various lending institutions as the numerous payment holidays and other measures come to a close in the near future?
Yes. So it started already. We saw it in January already. And so distressed lending was on the increase from Jan. The Feb numbers had peaked and they were 4-year highs. And we expect that to certainly filter into the numbers. Interestingly, I don't think it's going to materially impact the financial viability of our financial institutions, primarily because they've tended to have higher capital buffers in terms of the capital requirements that we've got. They've tended to be overcapitalized, if I can call it that, and therefore they've got room to absorb some of those losses and those loss provisioning. But it certainly means something quite material for households. And just to make an interesting point around that very same thing, around, in essence, the household viability, after the 2008 financial crisis and when jobs started trickling back, we saw that the earnings didn't trickle back at the same pace at which jobs were coming back into the economy. And that is probably also what's going to happen now, is that some of the people who've either worked reduced hours or have been laid off, when they come back, they're probably not going to come back on the same base in which they came out of. And that's certainly then going to continue being a pressure point for households, particularly, I think, Black households, where you've got more dependence and external dependence outside of one household. And so it's certainly one of the things that to look out for. But yes, the quick answer is that default ratios will certainly increase.
Sifiso, it's been an absolute pleasure again. Sorry that we didn't, to the attendees, that we didn't get to all the questions, but please, you can pose these to COBRA, and then we'll get these questions to Sifiso, and he can get back to you. As we, every day we have an opportunity to engage with our teams, and we will make sure that Sifiso gets any questions that you have. Guys, thanks for joining us again on COBRA this morning. As you know, every morning at 10 a.m. We have webinars. Next week, we've got a great offering. Dustin Graham and Carl Bates are here on Monday to talk about selling your business during COVID-19. We also have a mentalist, Gilan Bork, later on in the week. On a range of aspects. We don't just touch on business, but we look at other impacts, that other industries that have an impact on your business, on your daily life, so we can get you through this pandemic. Guys, thanks for joining us. If you have any questions, as I said, info@cobra.org.za. If you want to find out more about the COBRA initiative, go to www.cobra.org.za. Until Monday, goodbye.